Yeah, were you able to claim to do that?
No. All right, we'll call to order the August 18th, 2025 Oklahoma City MAPS Investment and Operating Trust. And we'll go to item number 2, which is approval of the minutes. We have A and B. We'll do those both together at the same time. The May 19th and July 24th minutes. Motion and second, record your votes. Passes unanimously. Now we'll go to item 3 for items for individual consideration. We're going to receive the general manager report for the period ending July 31st, 2025, and Matt Boggs, city treasurer, will provide us an update.
Good morning. Looking at the general manager report, if you look at the project value on page 2 of the report, really not a lot has changed since last year, but I won't steal Doug's thunder, but it was a good quarter from the investment standpoint. We did have one fiscal year 26 allocation that has been sent out so far, and we did this last time, but I just want to point out again that we've now split out Innovation District between the 2 sub-projects, just to keep track of that a little more accurately for this particular presentation. I would expect by the time we get to the November meeting, we'll have one other fiscal year 26 allocation that we'll have made. If you recall, we had our special meeting in July to make sure that the memorandum of agreement was between the city and some of the various trusts. And so I'd expect we'd see that in November, but our staff is working with, they're just making sure that all those transfers go through. So I could answer any questions you might have.
I know, Joe, but this is great news, and this is what it's supposed to look like, right? Mm-hmm. We remember the first 9 months, 12 months of this deal, so this is what it's supposed to look. Thank you, Doug, for all your work on this. So, all right, with that, I'll entertain a motion for item 3A. Record your vote. Passes unanimously. Now we'll go to item 3B, which is to receive the quarterly investment report for the period ending June 30, 2025. And we have Doug Anderson with Mariner here.
Good morning, Mr. Chairman and trustees. This will be a brief report in the sense that it's good news. But if there are any questions, I'm happy to go through those. Brief advertisement here. A year and a half ago, Mariner bought Andco, and just a few of the highlights at the bottom section here. 99% client retention rate, 99% employee retention, and expanded resources. You can see above that, the Coalition Greenwich, they're sort of the underwriter's laboratory for investment consultants, and we won it again this year, which makes 4 years in a row as Best Investment Consultant Award. This is rankings based on interviews of our existing clients. Not all of them, but a good cross-section. And so we're very proud of that for the 4th year in a row. You know all about our core services. And then here are some introduction to a few of the other things that we do. Remember, we're just institutional, our division, that's all we do, but we're part of a larger organization. And seeing how these combinations have happened in the past, I'm really pleased that they have divided us off into our own unit. And while I do talk to some of the folks on the wealth side, estate planning side, et cetera, it's arm's length. We'll bring up a few acquisitions that we have done. Remember when Mariner bought Andco, our assets under advisement were about $120 billion in assets, like yourselves out there. Through acquisitions and organic growth, but honestly, most of its acquisitions over the past year and a half, our assets under advisement are over $400 billion right now. Oh. So it has been big. But the good news is that we've done 3 acquisitions as of last week, but the 2 big ones were a company called 4th Street Investments out of Cincinnati, and they do nonprofit foundations and endowments, right, which is not a huge part of our business. Most of our business is public funds like yourselves. And then earlier this year, we bought Cardinal Investment Advisory, which, despite the name, is an investment consultant, but they work for insurance companies. and they're the second largest insurance company consultant in the United States. So those are very complementary to our core, which is public funds, in the sense that insurance is different. They have to deal with taxes, which is something we don't have to over here. And then foundations and endowment, that's a very closed market in some senses. So we are broadening our client exposure, and that's good for everything, and we're growing at the same time. So it's been a really good experience. So moving on to market environment, very good, very strong second quarter. You can see S&P up almost 11%, and international equity is up 12% at that time. So we have seen international equities stage a comeback. Part of that, I'll show you in a slide, is share price increases of those foreign shares, but part of that is also the dollar declining versus other currencies. And trailing one-year performance has been fantastic. Now, this is not without a 20% drawdown in the S&P over that period of time. So first quarter of this year and early second quarter, we saw a pretty dramatic drawdown in the U.S. equity market because of, the biggest reason, there are several, but the one everybody points to is Liberation Day. A lot of uncertainty in the marketplace as far as trade flows, et cetera. And the business interacting with the government in the United States as well as foreign responses. But if you look at the one-year performance below, it looks like it's been smooth sailing the entire time. But that does sort of disguise some of the volatility we've been through. So looking at that bottom chart, U.S. equities, we'll call large caps, up 15%. Non-U.S. equities, we'll call that 18%. And then even fixed income, remember, Brent, as you said a few moments ago, the first 9 months, interest rates or bonds were not yielding 6%. So as an organization that is targeting, loosely 4% spend rate, this part is very, very important, right? We don't have to overachieve on the equity side to make up for below 4% yields on fixed income. So what this shows right here is over the trailing year, despite volatility, uncertainty, and everything else that's going on in the world, portfolio really hit on all cylinders. And one other thing, I know we don't have to manage liquidity very much yet, but sometime in the future, we will need to plan ahead for these increased outflows, because that's what this fund is meant to do. But as of now, looking at the 3-month T-bill, that's about what you can get in money market funds right now. So we can even set aside future liquidity needs plenty in advance, shield it from volatility of the rest of the market, and still not have a negative impact versus that 4% spend rate that we're targeting. So I want to say I don't expect this return to happen on the coming year, but we have some very solid foundations underneath the portfolio that we didn't have when we started, right? You can get yield on fixed income and on very short-term fixed income. That can tide us over, whereas we were exposed in 2022. So going on through the picture, growth beat value, came back really strongly. Value did have a couple of good quarters, but the market is really being driven by, especially at the large side, by the so-called Magnificent Seven, which I'll show you on this slide. So the upper left-hand side, the blue table there, these are the top 10 largest companies in the Russell 1000. Remember, it's cap weighted. So the bigger the company, the bigger the impact on returns. And in only 2 short years, NVIDIA is now the largest company in the US equity market, which is astonishing. 2.5 years ago, they made chips for video games, but because of the GPUs that they make for AI and the AI data centers, and the demand for those from a lot of the companies that are just below it on this list, their returns have been nothing short of astonishing. And if we're looking at the 28% return over the last 1 year, remember, I think 2 quarters ago, that was over 100%. So even with the returns plateauing a little bit, it's still growing faster than most of the others. Looking down at the rest of that list, it is very technology or technology adjacent companies. The one that sort of stands out to me that as underappreciated is probably Broadcom, huge company, but they are not Microsoft, they are not Apple, they're not Amazon, they're not Facebook, but they are right up there amongst all of them. And Berkshire Hathaway, that is, of course, Warren Buffett just stepped down from the lead of that, but one of their largest holdings for about a decade has been Apple Computer, or Apple Inc. So the world right now, markets right now are being led by these technology companies, but it doesn't rhyme closely with, say, the tech wreck of 2000. Yes.
What does Broadcom, what does Broadcom do?
They're technology. They make chips and communication equipment.
Okay.
They're not making the GPUs. But even if you look at the foreign companies out there, the biggest ones that are doing the best right now, Taiwan Semiconductor, there's a Dutch ASML, they make laser lithography for computer chips. I mean, the demand is huge. I don't know how it will end. Hopefully it will end peacefully, but we can't have all of the portfolio in these stocks. And at this time, it's hard to say diversify away from it, but sometime in the future, we'll be happy that we did. So going into, this is an interesting chart, again, because international has done so well. But looking on the upper right-hand side, so this is the companies within the two indexes, and then it's kind of combined together. But Japan is the largest non-US equity market out there, followed by the UK, France, and now Germany has slipped all the way to number 4. And the big reason for that is energy policy and industrial policy, where they've really hurt the ability of their companies to operate. Germany, I don't know if it's widely known, but Germany has sort of hollowed out their energy infrastructure in a way. They shut down all of their coal plants, which I can agree with, all their nuclear plants. Their natural gas supply is disrupted. They can't get as much as they want to. And one of my favorite words is a German word called Dunkelflaute, which means wind drought, which in Oklahoma, we are perfect for having wind power and solar power, right? It's bright, sunny, and windy here a lot. But in Northern Europe, it's not always that way. Sometimes the wind is calm and it's cloudy, and they can't produce the amount of energy that they have great manufacturers, they have great chemical companies. They just can't get the power at a reasonable cost, so they're losing a lot of their industrial base right now. They've hollowed out their energy sector so much that in the wintertime, when they have spiked demand for electricity, they burn wood in their power producing facilities. It's one of the strangest things I've ever heard. But as we go down that list, China obviously is the largest EM market. Taiwan is very close to that. But again, I'm pretty hesitant to allocate a lot to those two countries just because of uncertainty there. Looking at fixed income, rates are stable. Yes.
How much of the growth rates for here on the international is related just to the weak dollar?
How much of it? Great point. I skipped over that, but these charts show you this. So over the trailing year, the all-country world index in US dollar terms was up 12%. In local currency terms, 6%. So 6% of that 12% return in the quarter.
So 50% of it?
Yes.
Okay.
And if you look at the trailing 1 year, it's not quite as proportional, but it's still significant. Again, it's been 15 years since we've seen this type of return from non-US equities. Fixed income, again, similar chart here. Good returns. High yield was the highest performer for the quarter and for the year, but then looking at the bottom, we don't look at the red columns here very often because I think that non-dollar fixed income is doesn't have the return profile I like. In this sense, this is very rare, but you see the global aggregate outperforming by 6%, like we saw just a moment ago, US fixed income. But that's mostly due to the dollar. The dollar's very volatile. And again, I don't want to inject unnecessary volatility into our fixed income exposure because it's the foundation. You can see that interest rates, Fed funds has stayed stable since the end of last year. People looking at unemployment and CPI, those are all backwards looking. But it gets a lot of attention in the financial press. I'd say it's probably 50-50 that the Fed cuts in September coming up. But given some of the inflation figures we've seen, it's a coin flip as of now. And now going into the portfolio, this is the most important figure right here, most important chart. Gray area is the net cash flow into the trust. You can see that from February of 2022. And remember, we started investing, we did do some dollar cost averaging, but right when we started investing was when Russia invaded Ukraine, and that was a pretty troubling period in the marketplace. But as of mid-year 2023, we had gone above principal value, and as of today, you can see that the gain has been as of June 30, almost $26 million, and income, $10.2 million. So that's a pretty important contributor to the gap in between the blue line, which is market value, and the gray box, which is the principal value. So this is interesting. Remember, we did do some very defensive market timing here. I'll call it what we did, but you can see it was relatively brief, and we did dollar cost average back into the equity portfolio. And our allocation right now is 47.5% domestic equities, 40% fixed income, 8.5% international, and 3.1% in cash. And that is allocated amongst the funds on this slide. We have a streamlined portfolio. We have some ability to invest beyond these asset categories. One of those that I think we may look at in the future, but not yet, is real estate, because it does have a relatively stable value over time and does produce income. The real estate market is in a continued period of distress, I would say. What worked 2 years ago is not working as well today, and by that I mean multifamily apartments. It's a city by city, almost a block by block issue. But I was talking to a real estate analyst this morning, and being that he's in Florida, he thinks that the real estate in the institutional market is sort of in the eye of a hurricane, and we don't know if the back wall is going to dissipate or if it's going to come back and hit us on the way out. So time will tell. I'm comfortable with the portfolio's allocations now, and especially if we can keep cash up for future flows out. I think it's a great way to stabilize the portfolio and allows us to have the 40% US equity allocation. So here's where we are. It says our fixed income exposure is out of its target ranges. These boxes correspond to the investment policy statement. The reason why we are above target in fixed income is those two bottom allocations have not been funded yet, and again, we have the flexibility to do that at our point of choosing. But again, U.S. equity slightly above target, international slightly above target, cash just below target, and remember, we want to keep that for stability, and again, not time yet to fund alternatives or real estate. And then cash flows during the quarter, distributions of $150,000, income of $929,000, and appreciation, really strong quarter, $7.4 million, yielding that ending market value. The index fund, the S&P 500 index, the biggest contribution there at $3.7 million total between income and appreciation. And as we go for the trailing year, almost $4 million in income and 10.6 in appreciation. So last year was good. Trailing year that we're showing right here is good. Let's not extrapolate this into the future. Let's be cautious about our expectations and remain flexible in case we do have that opportunity to fund real estate in the future.
But when you look at that, how much income do we think?
How much income do we need? So,
Yeah, I mean, we don't, $1 million, is it $1 million maybe we've allocated each year?
So that would be not quite 6 million, about $5.5 million in income at 4%. That's public math, so we'll need to check that.
Understood.
But we're very close, much closer than we were when this trust started because of the interest rate environment.
I was just concerned that once we start making more allocations, we could run into, or we got to go sell more investments to make people whole, which is what it's here for, and it's above the corpus, so that's good. But
Right.
I like the income, I like the outflow equaling being a little less than the inflow, just from an income perspective. So
That's fantastic. And it's a great way to look at it. I'm going to go back to this slide right here. So the good thing here, and again, that red triangle, don't be too concerned about that, right? It's just where we hold the funds that we've not yet funded in the bottom two categories. But should we need funds, and this is something that Matt and his staff and I talk about, the place we would go for that would be domestic equities, right? Because they are over their target weight, and in that way, we're selling the winners and funding income-producing assets. So with a long timeline, we're still thinking 40-plus years for this. That is the way to regenerate the portfolio. You will have to sell equities at some time. That will happen. Now, the nice thing about our liquidity profile here, everything is, we can be completely in cash in 3 days, the entire portfolio. So we don't have to worry about lockups or anything like that. So I like that. But I don't want to have to sell equities, but honestly, we will have to in time.
So just so I'm clear, the IPS has this outline as we could add these two other asset classes at some point
At some
in the
point.
future.
Yes. We have the flexibility to do that at our time of choosing. And right now, it seems that those are pretty volatile and it's looking uncertain. Real estate market.
I have a question. I'm
Yes, of
sorry.
course.
So how soon do you think that we can start selling equities or profit?
Well, if two things could happen, right? There could be, like Matt said earlier, in November, there could be capital asked for. We'd be able to fund that. It's what your estimate, 300?
Yeah, but it's about 200,000, I think.
About $200,000. So I look at that and I look at our cash composite, our reserve fund, if you will. We've got 20, he could do that 20 more times before we drew that down. Now, if the other case is that if the domestic equity composite or the international composite, if that green arrow went above, turned to red, right? If it went above, we would want to sell at that point.
But then would it be too late or?
No. So these ranges are fairly wide. And for it to go above that and stay above that, that would mean that we would be having a good market, right? And the other thing, as painful as it sounds to be, that's our primary risk control mechanism. Other than occasional market timing, defensive market timing. But now that the portfolio has built momentum, right? It has that forward inertia to it. I think that us doing another one of those, risk abatement trades, I think that it's less likely. In the early years, if you have a bad drawdown in the early years, it really is hard to come back from, right? But what we're trying to build is a machine that compounds more than 4% per year and is able to comfortably fund all of the projects that it's supposed to. So that's a good question, and these boxes really are to protect ourselves from our own short-term market views, right? It keeps us disciplined over a long period of time, and I've seen clients do this a lot. You know, you see your maximum allocation to domestic equities is 51%, and all of a sudden we're at 52 because the equities have gone up so much. The temptation is, well, why don't we just move it over a little bit? And that's not in accordance to our long-term plan, right? The plan is to have a portfolio that balances risk and return in a way that is comfortable for the long-term operation of this fund. Is it possible at some time in the future, if interest rates went down to zero again, and we wouldn't be able to make any yield off of those, that we would think about increasing equities? Possibly, but that would be a lengthy conversation. It's not something we just feel like doing. We'll do another asset allocation study, probably do an asset liability review. So again, policy is meant to be reviewed and maybe changed slightly, but not significantly.
So I have a question in that regard. When the policy was written, the alts and real estate were put in here at this strategic and tactical asset allocation ranges, but we have nothing in those. Understanding what the forecasted needs of these projects will be is certainly important, but these projects are designed to last for several years. I mean, how many years is it that we'll be working on these projects?
I would anticipate that some of these projects, we will be providing them operating funds from here for the next 20, 30 years.
Like into perpetuity?
Yeah, that would be our perspective.
So I guess my question is just trying to understand at what level above corpus do we say we need to adjust the allocation? Because I do think that if it's just by feel and market timing, I just don't think that's the right approach.
Sure. I would say real estate, so alternatives is very broad category, the first one. So again, I don't see anything in alternatives that offer us a distinct and attractive risk return profile right now. And I would say the same about real estate. And the thing about real estate that worries me is that these are private real estate projects for the most part, right? So limited partnership. And unfortunately, what I'm seeing in the real estate market are distressed sales right now I've seen a lot of stuff, but one of the things that I keep, it's probably confirmation bias, I admit to that freely, but you're seeing buildings, office buildings, large ones that transacted sort of before COVID, and the market value, the price that they commanded now versus the distressed sales that we're seeing, some of the, and again, the market value is not updated like our public assets, but I saw one last week that it was a large building, and I want to say it was in Chicago, but last time it sold, it was $141 million, and that was just before COVID, when interest rates were very low. And I think that the sale was about $25 million.
Look, I'm not suggesting that we do alts or real estate. That's not what I'm suggesting.
Okay.
I'm just saying if someone were to look at our IPS who has no idea what happens with the portfolio, they'd be like, oh man, they're out of policy. They have nothing here. So if maybe it's just a question of how often are we reviewing the policy, so such that maybe these just need to be zero, like we have no sort of stated range for what they can be. Because I don't remember the last time we've done that, but that's just me.
I think that's an apt point. And one way that I have seen this addressed in a similar situation is that you trace the minimum allocation instead of being 2.5% and 3% for those two categories. You can make it 0. The minimum could be 0, so technically you would be in line with the policy. Let me think about that, and I think it probably is a good, apt time to take a look at the policy statement. So maybe that can be a project for the coming quarter.
I like that, Ida, because you were talking earlier about the $400 billion that y'all have under management.
Yes,
I'm sure you have a significant amount of that invested in real estate.
yes.
And so, but everybody has different strategies, different ideals of what they're trying to accomplish. So yeah, I think that'd be good to everybody. I know that's not on the agenda, so, but I don't see anybody saying no, so.
There, duly noted. All right, I'm going to go through the rest of the report fairly quickly here in the interest of time. This is the big picture. So this is as of June 30, calendar year to date, 5.81% above benchmark. The year 2024, 10.95 above benchmark, and 2023, 14.13. And remember that we funded in April of 2022. And if I go back here, again, it's similar figures, but as I go to the right-hand side, since inception, given the nature of this trust, 5.83% annualized rate of return of the total fund. The index fund, the Fidelity 500, 13.58%. That's too far back, I'm sorry. 3 years, 19.7, 21st percentile. Vanguard Midcap, 14.3, 21st percentile. And even the small cap, 3 years, and 3-year annualized at 12.16. So all of those are passively managed vehicles, and they're all outperforming their universe median and benchmarks by narrow margins. The international equity for the year, 18.46%. So very strong contribution from that 8.5% of the portfolio. And then looking at our two fixed income funds, the core is Dodge & Cox. It's 35%. It's the largest allocation we have. And over the last year is up 6.49%, 15th percentile. If you look at the out-year returns there, very strong. First percentile, which means they outperformed virtually everyone else in the fixed income world. And then the high-yield bond fund, 10.71 for the 1 year, ranked in the 7th percentile. And even cash was up 4.68%. So when I say the trailing year, the portfolio ran on all cylinders. Every major category we have was above the 4% return target. So going on into the last thing we need to talk about are fees. These are the investment management expenses. You can see that for a portfolio of this size, $141 million, the total fund weighted average expense was 20 basis points. And you are one of the few funds that I have that the highest cost asset category is fixed income. Your domestic equity and your international equity are extremely inexpensive because it's all passive, and it's worked very, very well. So 20 basis points is lower than $20 billion funds that I see in the world because of the structure. It's delivering the returns that we hope to have, that we hope, and that our fixed income managers, where we're paying the active fees, those are paying for themselves. All the returns we show are net of investment management fees. So with that, I'm happy to open to any additional questions.
Any other questions for Doug? All right, well then I'll entertain a motion to receive item 3B. Passes unanimously. Now we'll go to item 3C, which receive the monthly investment reports for May 31st, June 30, and July 31st.
Thank you, Sean. Perfectly to July 31, since we've covered the other reports. And it was another good month. For the month, 0.93%, which is above benchmark, and you can see the 1 and 3 year results are both above 9%. So we've doubled, more than doubled the return that we had hoped to. And as you see for the quarter, equities were strong. International equity down a little bit, and then the core fixed income down slightly, but still outperformed its benchmark and its peers. And that is all I have to add for the 731.
All right, any questions regarding 731? Then I'll entertain a motion. Motion is second. Record your votes. And it passes unanimously. Now we're on to item, thank you, Doug.
Thank you.
Now we're on to item 3D is renewal number 4 of agreement with Mariner Institutional for investment consulting. The estimated cost of $65,000 for September 7th, 25 through September 6th of 26. And this will be our final renewal, and then we'll have to go out for an RFP process pursuant to our policies. So I'll entertain a motion on item 3D. Record your vote. Passes unanimously. Now we're on to item 3E, amendment number 3, and restated audit contract with Allen, Gibbs, and Hulick to include audit services for fiscal year 24-25 with estimated cost of $13,628. All right, passes unanimously. Now we're on to item 3F, is to ratify the claims from April 16th, 25 to July 22nd, 25. Are there any questions of staff regarding the claims? Not seeing any, I'll entertain a motion. Passes unanimously. Now we're to item 4. We have comments from trustees, staff, and interested parties. Have anything? Well, then we were at item 5, adjournment here at 10:37 a.m. Thank you.